So when it comes to getting a loan, there are multiple options, and multiple options within the loan, multiple options within conventional. One of the options that you have is doing an ARM. What and everybody I think has heard about an ARM. Everybody's scared of ARMs because it destroyed us 10 years ago, 15 years ago, whatever it was. I'm seeing them more and more. So explain to us how an ARM works and what do we have to be what do we have to know to be educated enough to know if it's right for us or not?
I think just a caveat: the ARMs that were around before were, from what I've heard, very called exotic loans, and there were some out there. Again, you had people that were not verifying income. They were not looking at pay stubs. They just had a quick phone conversation, pulled credit, boom, you get a loan. That's not how mortgages work nowadays. So the negative stuff about ARMs are something to be cautious about, but they can be a good strategy if you kind of cover your bases. And the most important things to look for in current ARMs are how long is the fixed period. So adjustable rate means adjustable rate mortgage. It could be adjustable from day one. Every month you could get a new rate depending on what index it's tied to. Or the ARM, most common ARMs are 5-year, 7-year, 10-year. Those are probably the three most common products out there. And what that means is the bank's not going to be hooked to a 30-year fixed loan. It's going to be only fixed for 5 years, and therefore you get a lower rate than a more longer-term 30-year fixed loan.
And does it balloon at the end of that fix, and
No,
you have to pay it back at the end of the 5-year ARM?
No, it just goes to that's the other thing to be cautious of, the maximum interest rate and how often it would adjust after the fixed period. Okay. So most common ARMs, let's say a 5-1 ARM, means it's fixed for the first 5 years, and then each year thereafter, every year it will adjust, and those typically have a maximum of 5%. So in the first year, your rate could adjust as high as 5% higher. In the first adjustment year, your rate could adjust as high as 5% higher. So year 6.
That's pretty significant.
It is significant.
So
what I typically tell people is, if you're going to do an ARM, you want a strategy that you're going to either refinance out of that loan, or you're going to have a way to pay off the loan or sell the house. And that's the most common. If people are temporarily here, I had one client that was here only for 5 years. So he took out a 7-year ARM. I followed up with him year 6, and he said, house is on the market under contract.
Got it.
And he saved a significant amount of money versus a 30-year fixed with the ARM. And again, the average home time people buy is seven-ish year.
Yeah, and are you paying down the same amount of principal in an ARM as you would in a normal conventional? It's just the interest rate that's different, right?
Correct,
It has nothing to do with how much principal or how much anything.
Right.
And then what about requirements to get into it? Can you still do this with 3% down, with 5% down, with whatever amount down?
Sure, yeah. FHA does have an ARM. I have not seen that popular.
Let's skip that.
So
just go. Let's be conventional.
I believe it's currently. I think they just changed it that you can do 5% down and do an ARM. The qualification requirements, if you do less, if a 5-year or less, is that you have to qualify at a higher rate, 2% higher. So the qualification is a little bit tricky depending on what fixed term you have.
But so you got to be pretty qualified if you want to do an ARM.
Yeah,
is what it comes down to.
It's not something that I would recommend unless you for sure have a way to get out of the house. And if you run the actual numbers in that first adjustment year, if it's at the max, you would lose almost all that interest savings within that 1 year. So if you're 1 year after rates are at the max, you could lose all that. So there's something that can make sense, but you just want to make sure you've really run the numbers.
And we're getting a little bit long on this video, but what's the real advantage? So generically speaking, if I've got 4% interest rate today on a normal conventional loan, how much lower am I getting on an ARM?
Just
is it 3.5? Is it 3? Is it?
It's probably a 1%. Roughly speaking, off the top of my head, 1% for a 5-year versus a 30-year. So you're saving 1% every year that it's for that first 5 years. 7 years probably a little bit higher, lower 3s, and then 10 years probably mid to upper 3s. So not much savings.
Right.
So the longer the fixed period, the higher the rate, the less the benefit.
Got it.
But also the more security.
Okay.
So
very cool. Thank you.